Okay, so lately, it seems like everyone's a little on edge about their money, right? You see those headlines about markets crashing, and you can't help but wonder, like, is this a big deal? Should I be worried? And that's exactly what we're going to do today. Dive deep into what's going on and why it matters to you. Even if you think, like, Wall Street's just a street in New York, this stuff actually affects all of us. So have you heard this phrase, the everything bubble?
Hmm.
It's kind of like, imagine like everything valuable, stocks, houses, even those digital currencies, it all got really expensive, like super fast,
Fun.
all at the same time, kind of like a giant financial balloon that someone keeps blowing up. And now, well, maybe that balloon's starting to like spring some leaks.
Yeah. I think what we're seeing right now, it's not just a few dips in the market. I mean, it's like a global synchronized dance, but everyone's kind of stepping on each other's toes.
Yep.
The U.S. market alone has lost like a mind-boggling $4 trillion in just the past 4 months. That's trillion with a T, and India's market,
Hmm.
a trillion down. And it's not just these two big players, right? If you look around the world, the Dow Jones, the Nikkei, the Sensex, the Nifty 50, everything, they're all down significantly. And this kind of synchronized downturn, it's definitely got everyone on edge, right?
Yeah, it's like the ground is shifting under our feet, for sure.
Yeah.
So what's causing all this global market mayhem? Like, can we point to a single bad guy, or is it a whole team of villains?
Well, it's rarely as simple as pointing fingers at one single thing. The truth is, it's usually a tangled web of different factors, all kind of stirring the pot at the same time, right?
Right.
I mean, think about it. The war in Ukraine, that's been going on for a while now, right? That's been a huge disruptor. It's really messed with energy supplies, food supplies.
Yeah.
It's causing prices to spike globally. Then, we've got this possibility of a recession looming in the U.S. And whenever the U.S. sneezes, the rest of the world catches a cold, right? That has a ripple effect on everyone. And then on top of all of that, we've got this massive global debt problem, like a time bomb just ticking away in the background. It's a lot to handle.
It really does feel like we're playing financial dodgeball and just getting pelted from all directions. But let's unpack this everything bubble idea a bit more. Is it just, a catchy phrase the media likes to throw around, or is there actually something more to it? I mean, markets go up and down, right? It's kind of what they do.
Well, the theory behind the everything bubble is that this time it's different. It's
Yeah.
not just the normal ebb and flow.
Yeah.
For years, especially after that 2008 crisis, central banks all around the world, they've been pumping tons of cheap money into the system. Imagine it like turning on this giant fire hose of cash. And this easy money, well, it made it really, really simple to borrow and invest. And that's what
Really?
drove up asset prices, everything, across the board, houses, stocks, everything.
Right.
But here's the catch. A lot of those investments, they were based on speculation, not actual economic growth.
Oh.
And now, as interest rates start to rise, that easy money fire hose is, well, it's starting to get turned off.
Mm-hmm.
And those prices, those inflated prices, they're starting to look a little shaky.
Yeah, I see. So it's like we're holding our breath, waiting to see if this bubble's going to slowly deflate or if it's going to just pop dramatically. And of course, we can't ignore the elephant in the room, right? We have people like Robert Kiyosaki, the rich dad, poor dad guy. He's predicting a crash bigger than the Great Depression. How seriously should we be taking those doomsday warnings?
Well, Kiyosaki, he definitely knows how to grab those headlines.
Mm.
And his warnings, they're getting a lot of attention, that's for sure. So it's important to understand where he's coming from. But I think it's also important to keep things in perspective. Remember,
Yeah.
market corrections, they're normal. They happen. It's like the economy taking a deep breath before it keeps on going,
Yeah.
right? The difference between a correction and a full-blown crash, it all comes down to the magnitude and the speed of that decline.
Okay.
So while it's smart to be aware of the risks out there, let's not jump to conclusions about a complete economic meltdown just yet.
Right, like it's the difference between hitting a speed bump and driving off a cliff.
Mm.
So, I mean, we had a pretty steep correction back in 2018. The S&P 500 dropped 20%, but it did recover. So what makes this time right now feel different?
You're right. Markets do go up and down. It's what they do.
Yeah.
But this time around, I think it's the sheer breadth of the decline across all these different asset classes, stocks, bonds, real estate, even Bitcoin. It's raising eyebrows.
Mhm.
Back in 2018, the main concerns were interest rates and trade tensions. But now we have those same concerns, right? But they're amplified. Plus, you had the war, global inflation, And that mountain of debt we talked about just looming over everything, it just creates this much more complex, much more volatile situation, which naturally makes people uneasy.
Okay, so it's not just like isolated issues happening in different places. It's more like this domino effect with one problem kind of triggering another. It
Yeah.
feels like we're playing Jenga with the global economy, and someone, somewhere, just pulled out a pretty crucial block.
Yeah.
So let's try and break down some of these risks in a bit more detail, right? Starting with this war in Ukraine, how does a conflict on the other side of the world, how does that directly impact our lives over here?
Well, the global economy, it's far more interconnected than we often realize. I mean, the war in Ukraine, it's driven up oil prices, right?
Right.
That means we're paying more at the gas pump. It's disrupted those global food supplies because Ukraine was a huge grain exporter. So that also leads to higher prices at the grocery store.
Yeah, I've noticed.
And then you got China. China's a global economic powerhouse,
Mm.
and they're experiencing a slowdown right now. And that can create disruptions in those supply chains,
Mm.
which affects, the availability and the cost of all the goods we use every single day.
Mhm.
Everything.
Right. So even if we're not out there actively buying stocks and bonds, these global events, they still have very real world consequences for all of us. They touch our lives in some way.
They do.
Okay, so let's talk about that US debt.
Yeah.
That number $34.6 trillion. It's so big. It's almost impossible to even imagine. How did we get here? And what does this massive debt burden mean for the future?
It's a good question. And the U.S. debt has been building for decades, really, but it's really ballooned in recent years, especially during the pandemic when the government spent heavily on all those stimulus measures.
Mm.
And now, as interest rates climb, the cost of just servicing that debt, just paying the interest on it, is becoming a serious burden.
Wow.
And you remember how we talked about the 10-year Treasury yield? It was around like 1.5% in 2021.
Yeah.
Well, now it's hovering around 4.5%. That jump means borrowing costs are rising, not just for the government, but for businesses, home buyers, everyone, really. And that can really put the brakes on economic growth.
It sounds like the Federal Reserve is stuck between a rock and a hard place.
Yeah.
If they cut rates to help the economy, they risk making that inflation even worse.
Right.
But if they raise rates to fight inflation, that debt burden just keeps getting heavier, and that could also slow down the economy. It's like they're trying to steer this ship through a really narrow channel with rocks on both sides. So
Yeah.
are there any historical examples, like anything we can look at to understand what could happen?
There are actually some interesting parallels with what happened in Japan back in the 1970s and 80s.
Oh,
Back then, the Bank of Japan, they they let debt and inflation grow faster than the economy. And that created a huge asset bubble. And when that bubble burst in 1990, Japan went through this period of economic stagnation. They called it the lost decade.
the lost decade.
Yeah. Their debt to GDP ratio, it shot up to 250%.
Wow.
It's a pretty stark reminder of what can happen when debt becomes unsustainable.
Yeah, a lost decade does not sound like a good time. So are we saying the U.S. is headed down that same path?
Not necessarily.
Okay.
I mean, the U.S. is in a different position than Japan was back then,
Mm.
but it's definitely a cautionary tale, It highlights just how important it is to manage debt responsibly.
Right.
And it shows the potential risks if it's allowed to, to spiral out of control.
Anyway, so we've got this global instability, right, and a potential debt crisis here in the U.S. and this looming everything bubble. It's enough to make anyone want to bury their head in the sand. But before we give in to, complete economic anxiety, let's shift our focus a bit. Let's talk about India. India is often seen as a rising star in the global economy, but now it seems like they're caught in this downward spiral as well. What's going on over there?
India's market has seen some incredible growth over the past decade, but recently things have definitely taken a bit of a turn. The Sensex and the Nifty 50, they hit record highs in 2024, but they've dropped over 15% since then.
Yeah.
And foreign investors, they're pulling their money out. And even seasoned market watchers, people like Shankar Sharma.
Shankar Sharma?
Yeah, he's a big name in investing.
Yeah.
Well, even he is sounding the alarm bells.
Wow. Okay, so Shankar Sharma, what's he saying about the Indian market?
Well, Sharma is predicting that the Nifty 50 could deliver like zero returns for the next 4 to 5 years. He believes that the market's impressive performance, that it was actually built on this kind of shaky foundation of, foreign capital, low interest rates, and maybe a little bit too much optimism. And now, as the global economy weakens and India faces its own internal challenges, reality is reality is sitting in.
Zero returns for 4 or 5 years. That is a pretty bleak outlook.
Yeah.
So what's driving this pessimism about the Indian market? Like, what are the specifics?
Well, there are a few things. We're seeing weaker corporate earnings, stock valuations are still pretty high, and that global economic slowdown we talked about, well, that's definitely putting a damper on India's growth prospects.
Right.
And then you've got the rupee. It's weakened against the dollar, and that puts a lot of pressure on importers,
Yeah.
and it fuels inflation.
So is India's story just a reflection of this global everything bubble, or are there specific challenges that are unique to their economy?
Honestly, it's probably a bit of both. I mean, India definitely got caught up in that global wave of easy money, and inflated asset prices that we've been talking about.
Right.
But they also have their own set of structural issues that need to be addressed,
Hmm.
like things like infrastructure bottlenecks, bureaucratic hurdles, a complex tax system, things like that.
It sounds like a perfect storm of internal and external pressures.
Yeah, it is.
So before we wrap up this part of our conversation, it's been it's been kind of a lot. Is there any good news on the horizon? Are there any glimmers of hope amidst all this doom and gloom?
Well, you know what? It's not all doom and gloom. There are a few potential bright spots,
Okay, good.
but I think we should approach them with a healthy dose of cautious optimism.
Okay, I'm ready. Hit me with them. We could all use a little dose of optimism right now.
So firstly, it seems like the pace of those foreign investors pouring their money out of India, it's actually slowing down a bit. Now, this could be a sign that the market is starting to stabilize. Or it could just be a temporary pause. We'll have to wait and see.
So a possible sign of stabilization, right? That's good. What else?
In the U.S., some analysts are saying that this recent market decline, it's actually corrected some of that overvaluation we saw in previous years.
Yeah.
The S&P 500 price to earnings ratio, which was pretty high for a while there, has come down to a more reasonable level.
So a potential reset of valuations, huh? That could actually be good news for long-term investors. Anything else?
There's also hope for some coordinated global action to kind of help stabilize things. The upcoming G20 summit in April, that could be a good opportunity for these leading economies to get together, right, and work together to address some of these shared challenges. Like think back to those coordinated rate cuts during the 2008 financial crisis. That kind of collaboration, it can really help restore confidence and hopefully prevent a deeper downturn.
Coordinated action. That's what we need. We're all in this together, right?
We are.
So any other reasons for optimism?
Don't forget about China. They've recently announced some pretty big stimulus measures, including like $500 billion in infrastructure spending. This could potentially boost global demand and maybe provide a lifeline to some of those struggling economies.
Okay. So China's stepping up. That's a good sign.
Yeah.
But it's still all very uncertain.
Absolutely.
Yeah.
It is. There's, possibilities, not guarantees. The global economy, it's a very complex system. And predicting the future, well, it's always tricky.
Well, I guess that's why we do these deep dives to try and make sense of this crazy, complex world and navigate these uncertain times.
Exactly. Staying informed, understanding the risks, and being prepared for different scenarios, that's the best way to approach this volatile landscape.
Right.
And remember, this is a story that's still unfolding.
Okay, so we just talked about some potential bright spots on the horizon, which is, it's good to hear, some good news. But I think it's also important to really dig into some of the risks we've touched upon, right? Especially this whole everything bubble idea. What are some, concrete signs that a bubble is actually about to burst? Like, what should we be watching for?
That's a really important question. Recognizing those warning signs early on, it can really help you make better decisions.
Right.
So one classic indicator, it's excessive valuations. Like when prices of assets, stocks, real estate, things like that, when they're way higher than what they're actually worth.
Okay.
Based on, underlying economic factors.
Yeah.
It's like paying $100 for a $5 pizza just because everyone else is doing it, right? Think back to that dot-com bubble back in the late 90s. Companies with like no real profits, they were trading at these ridiculously high valuations.
Right. And then that bubble burst and a lot of people got burned. So sky-high valuations, that's one red flag to watch out for. What else should we be on the lookout for?
Another sign is frenzied speculation. This is when people are buying assets just because they think the price is going to keep going up, regardless of any real value or any underlying logic. It's like, remember the housing bubble back in the mid-2000s?
Oh, yeah.
people were flipping houses like pancakes, convinced that prices would just rise forever.
Right.
They ignored those, fundamentals, and they just focused on those quick profits.
And we all know how that ended. So irrational exuberance, right? And a disconnect from real value. That's another warning sign. Anything else?
Keep an eye on debt levels. When individuals, businesses, and governments, when they take on too much debt to fuel their spending or their investments, it creates a really fragile foundation for the economy as a whole. If interest rates rise or, asset prices start to fall, that debt burden can quickly become unsustainable. And that leads to, defaults and potentially a financial crisis.
Yeah, excessive debt, that's definitely something to watch out for, especially given the US's current situation.
Yeah.
Are there any other indicators that we should be paying attention to?
Well, I'd say pay attention to market sentiment, the overall mood and attitude of investors.
Okay.
When everyone's super optimistic and complacent, assuming the good times will just roll on forever, it could be a sign that a correction's coming.
Right.
On the other hand, when fear and panic grip the markets, well, that can become a self-fulfilling prophecy leading to a really sharp downturn.
It seems like finding that right balance, being aware of the risks without giving in to that irrational fear, it's like walking a tightrope, especially right now.
Yeah, it is. It's definitely a balancing act. And that's why it's so important to, stay informed, do your research, and if you need guidance, consult with a trusted financial professional, someone you can talk to.
Yeah, that's always good advice. So we've talked about these global risks, right? And this everything bubble, the possibility of a crash. It can feel pretty overwhelming. But let's bring this down to earth for a moment. What does all of this macro stuff mean for the average person out there, the person who's not a Wall Street trader or a financial expert? How do these big picture economic trends, how do they actually affect our everyday lives?
That's a great question. Even if you're not out there, actively trading stocks or bonds every day, these global economic shifts, they can ripple through your life in really significant ways.
So can you give us some concrete examples? How does this macro stuff translate into, real world impacts?
Sure. I mean, think about your job security, for example.
Yeah.
If the economy slows down, businesses might, cut back on hiring. They might even lay off workers.
Right.
And then your purchasing power, that can be affected by inflation. If prices rise faster than your income, well, it just erodes your ability to buy the things you need and want.
Yeah, makes sense.
And your retirement savings, they're definitely not immune either.
Right.
If your 401k or your IRA, if that takes a hit because of market fluctuations, well, it can really impact your long-term financial security.
So it's not just about those numbers on a screen. It's about real people and their livelihoods. These economic forces, they have a tangible impact on our lives, whether we're following the financial markets closely or not.
That's right. It's about financial literacy. It's about taking steps to protect yourself, protect your family, understand what's going on.
So what are some practical steps that people can take to navigate these uncertain times? What can we do to feel a little bit more in control of our financial futures?
Well, I think creating a budget and actually sticking to it, that's essential.
Okay.
It helps you track your income, your expenses, pinpoint those areas where you can maybe cut back a little bit, and it helps you build that financial cushion for those unexpected events that always seem to pop up.
Yeah, budgeting.
Yeah.
The cornerstone of financial stability, right? So what else can people do to kind of like strengthen their financial foundation?
Paying down debt, especially that high-interest credit card debt, that should be a big priority.
Right.
The less debt you have, the less vulnerable you are to those economic shocks.
Yeah, debt can really, really drag you down. Getting rid of it should be at the top of the list. So what are some other ways that people can kind of prepare for those potential economic storms?
Building an emergency fund, that's crucial. You should aim to have at least 3 to 6 months worth of living expenses, saved in an account that's easily accessible.
Yeah.
The safety net can provide a lot of peace of mind, a little bit of financial security if you lose your job, if you have unexpected medical bills, anything like that. Emergencies happen.
Right. An emergency fund. It's like an insurance policy for your financial well-being.
Yeah. So what about investing? What advice would you give to people who are feeling, a little lost or maybe hesitant in this kind of uncertain market environment? I think diversifying your investments is really key here. Don't put all your eggs in one basket. Spread your investments across different asset classes.
Hmm.
Stocks, bonds, real estate, commodities, even those alternative investments like precious metals, or even cryptocurrencies. This can help mitigate risk and potentially even enhance those returns over the long term.
Yeah, diversification's about spreading the risk, right?
Yeah.
Not putting all your faith in one particular investment. But with so many options out there, how do you even decide what to invest in? Where do you even begin?
Well, that's where that research and due diligence come in. Before you invest in anything, take some time, understand it thoroughly. What's the company's business model? How are their financials looking? What are the potential risks? What are the potential rewards?
So it's like anything else, right? Do your homework. Knowledge is power, especially when it comes to investing. What other factors should people be thinking about?
Think about your risk tolerance. How much volatility are you comfortable with? If you're a conservative investor, you might want to lean towards, less risky assets, things like bonds. But if you're more comfortable with a little bit of risk, you might allocate a larger portion of your portfolio to, stocks or those other growth-oriented investments.
It's all about knowing yourself, right? And
Yeah.
and knowing your comfort level with risk. Any other tips for navigating this potentially bubbly market?
You could consider using a dollar cost averaging strategy.
Okay.
This involves investing a fixed amount of money at regular intervals, regardless of what the market's doing. It's a disciplined approach, and it helps to kind of smooth out that market volatility, and it also reduces the risk of buying high and selling low, which nobody wants to do.
Right, dollar cost averaging. It takes the emotion out of it, right? You stick to the plan and you let time work its magic. So what about preparing for the possibility that this bubble might actually burst?
Well, it's wise to remember that bubbles, they do eventually burst.
Right.
Now, we can't predict exactly when or how it will happen, but it's important to be prepared. That means, having a plan. How are you going to react if the market takes a sudden downturn?
So having an exit strategy just in case things go south.
Yeah, exactly.
Okay, what else should investors be thinking about?
Don't chase returns. It's really tempting to, jump on the bandwagon when an asset is skyrocketing in value,
Mm.
but, what goes up must come down. Don't let greed cloud your judgment. Right. Stick to your investment plan and avoid making those impulsive decisions based on fear or that feeling of missing out, FOMO as they call it these
Right,
days.
FOMO, the fear of missing out. It's powerful, but it can lead to some really bad decisions.
It can.
So resist the urge to follow the herd. Are there any other words of wisdom you can share?
Remember that there are always opportunities, even in a bubble environment.
Hmm.
While some assets might be overvalued, others might be undervalued. It's about doing your research, identifying those hidden gems, and then having the patience to wait for the market to catch up, to recognize their true value.
So it's not about, sitting on the sidelines waiting for everything to fall apart. It's about being selective, being strategic.
Exactly.
Okay, good. Any other thoughts?
Yeah, I think it's also worth considering, seeking advice from a financial professional. If you're feeling overwhelmed, if you're unsure about how to navigate this, complex market, a financial advisor can provide that personalized guidance, tailored to your specific situation and your goals.
That's great advice. A financial advisor can be a really valuable resource, especially when things feel, a little uncertain. So to wrap up this part of our deep dive, what are some key takeaways for our listeners?
I think the key takeaway here is that even in the face of, all this global uncertainty, this potential everything bubble, there are steps you can take to protect yourself, protect your financial well-being. It's about being informed, being prepared, and being proactive. Knowledge, it really is power.
All right, so welcome back to our deep dive into the everything bubble. We've talked about the global economic picture, the risks out there, and some practical steps, right, to protect your finances. But now I think it's time to really focus on how to actually navigate this crazy market, right? And maybe look at some investment strategies. How do you find opportunities amidst all this uncertainty and, build a portfolio that actually aligns with your goals?
Yeah, investing in this kind of bubble environment, it can really feel like walking a tightrope. You
Yeah.
got the potential for those big gains, right? But the risk of a sudden fall is also pretty high. So keeping a clear head, having a well-defined strategy and definitely a healthy dose of caution, those are essential.
All right, so let's start with the basics then. For someone who's, maybe feeling a bit overwhelmed by all this talk of bubbles and crashes and everything, what would you say is a sensible approach to investing right now?
First and foremost, don't panic. It's so easy to get caught up in the fear, right? To make those impulsive decisions that you might regret later.
Right.
But that rarely leads to success in investing.
Mm-hmm.
So take a deep breath. Assess your financial situation and really take a look at your investment goals. What are you trying to achieve?
Okay. So don't let emotions drive your investment decisions. What else should people be keeping in mind right now?
Well, remember that time is your ally. Investing is a long game. Those short-term market fluctuations, they're inevitable. They're going to happen.
Right.
But over the long term, markets, they tend to trend upwards. So if you have a long-term investment horizon, try not to get spooked by those temporary dips and dives. It's going to happen. Just ride them out.
Yeah, stay calm and focus on the long term. That's a good mantra for any investor, really. What else?
We've talked about it before, but diversify your portfolio. Don't put all your eggs in one basket.
Right.
Spread your investments across different asset classes. Stocks, bonds, real estate, commodities, and even those alternative investments. Like precious metals, cryptocurrencies, things like that. This helps to mitigate risk, and it can potentially even enhance those returns over the long haul.
Diversification, like creating a financial safety net.
Yeah.
Okay, but with so many options out there, I mean, how do you actually decide what to invest in? Where do you even begin?
Yeah, that's where that research and due diligence that we talked about before, that becomes crucial.
Right.
Before you invest in anything, take the time, understand what you're getting into, consider the company's business model. How are their financials looking? What are the potential risks and rewards?
So do your homework. Knowledge is power, especially when it comes to investing. What other factors should people be considering when making these decisions?
Yeah, I think it's important to think about your risk tolerance. How much volatility are you actually comfortable with? If you're a more conservative investor, you might want to lean towards, less risky assets like bonds. But if you're more comfortable with risk, you might want to allocate a larger portion of your portfolio to stocks or those other growth-oriented investments.
Right. So know yourself and your risk tolerance. That's another classic piece of wisdom that definitely applies to investing. Anything else?
Yeah, consider using a dollar cost averaging strategy. This involves investing a fixed amount of money at regular intervals, regardless of what the market's doing.
Yeah.
It's a disciplined approach.
Yeah.
Helps smooth out that market volatility and it reduces the risk of buying high and selling low, which nobody wants to do.
Right. Dollar cost averaging takes the emotion out of it. You just stick to the plan and you let time do its thing. So what about preparing for the possibility that this bubble might actually burst? Like, how do you do that?
Yeah, it's smart to remember that bubbles do eventually burst, right?
Right. Yeah.
Now, we can't predict exactly when or how it'll happen, but it's important to be prepared. That means having a plan for how you're going to react if the market takes a sudden downturn.
Okay, so have an exit strategy just in case things really go south. What else?
Yeah, and don't chase returns. It's tempting. You'd see an asset skyrocketing in value and you just want to jump on that bandwagon.
Right.
But remember, what goes up, it must come down. So don't let greed kind of cloud your judgment. Stick to your plan. Avoid making impulsive decisions based on fear or that FOMO, that fear of missing out.
Right, FOMO. It's a powerful emotion, but it can be disastrous for your portfolio. So resist that urge to follow the herd. Yeah. Any other words of wisdom you want to leave us with?
Yeah, I think it's important to remember that there are always opportunities, even in a bubble environment. While some assets might be overvalued, others might be undervalued. It's about doing that research, identifying those hidden gems, and then having the patience to wait for the market to kind of catch up and recognize their true value.
So it's not about sitting on the sidelines waiting for everything to implode. It's about being selective, being strategic with your investments.
Exactly.
All right, good. Any other final thoughts you want to share?
Yeah, if you're feeling overwhelmed at all or unsure about how to navigate these times, consider talking to a financial professional. A financial advisor can provide that personalized guidance, tailored to your specific situation and goals.
Yeah, a financial advisor can be a really valuable resource, especially when things feel a little uncertain. All right, so as we wrap up our deep dive into this whole everything bubble thing, what are the key takeaways for our listeners?
I think the key takeaway here is that even in this environment, right, with all this uncertainty, there are ways to invest wisely and build a resilient portfolio. It's about staying informed, being disciplined, diversifying those investments, and managing your risk. Remember, it's a marathon, not a sprint.
Great advice. Stay calm, stay focused, stay informed, and if you're ever in doubt, don't hesitate to seek out some professional guidance. This world of investing, it can be complex and unpredictable, but with the right knowledge and approach, you can navigate the ups and downs and hopefully achieve those financial goals.
Absolutely. The best investment you can make is in yourself, really. The more you learn about finance and investing, the better equipped you'll be to make those sound decisions and really secure your financial future.
Couldn't agree more. Well, that wraps up our deep dive into the everything bubble. We hope you found this episode informative and maybe even a little empowering. Remember, knowledge is power, and informed investors are empowered investors. Until next time, stay curious, stay engaged, and keep learning.
And remember, while this everything bubble, it might be a real concern, it's not the end of the world. By staying informed, adapting to changing conditions, and making smart choices, you can navigate this challenging landscape and come out stronger on the other side. So keep exploring, keep learning, and keep investing in your future.